very big welcome to our first webinar of 2022, and also the first webinar of our 30-minute webinar series. Today's topic, as you can see here, is Beyond Tracking Error, a novel approach to benchmark-aware portfolio construction. Please feel free to drop any questions and comments in the Q&A box. As it is a 30-minute webinar, we probably won't have time to go over them during today's session, but we will respond directly via email, so please feel free to do so. My name's Joyce Chu. I'm part of the Wealth Tech team and leading our sales structuring efforts at InvestSuite. First, I'll highlight a few key points about InvestSuite. I'm also joined by my colleagues. First, Emmanuel Wildiers, Head of Investments and Research and Development at InvestSuite. He will go over benchmark-aware portfolio construction, the advantages and shortcomings of tracking error, and some possible alternatives in InvestSuite tools. Then I'll introduce Martin Wins, Senior Product Manager. He will discuss what this all means in practice, comparing tracking error with our proprietary relative IVAR. He'll demonstrate this live through our model portfolio builder and wrapping up with some backtesting results over differing scenarios. So first about InvestSuite. We are a global B2B wealth tech and invest tech provider, and we offer solutions in the front to middleware space. We've successfully combined a broad range of skill sets in banking, creative design, behavioral science, engineering, and mathematics to bring to the market mind-blowing technology in a creatively designed, human-centric way. While we're B2B only, our solutions are always keeping the end user, your clients, at the forefront of the investing experience. So as technology continues to change, we foresee that the future investing, if not already, will be highly digital, AI-supported, hyper-personalized to the individual investor's preferences and goals, and most importantly, purposeful. In essence, what we do is help financial institutions of all types, banks, wealth managers, private banks, asset managers, pension funds, and more. And we help them realize their digital transformation journeys, democratize wealth management, and create the most delightful investing experiences for their customers. Combining our vision and our purpose that I just highlighted, this is exactly what we do. We build highly scalable and AI-supported invest tech solutions for these institutions, so they can serve their clients with best-in-class, cost-efficient, and profitable products. We do this with a suite of solutions, which I'll quickly highlight. If you'd like to learn more, please feel free to connect with me after today's call. First, on the left, we have our Self-Investor, a best-in-class white label execution-only platform made for easy investing. Robo-Advisor, this is a low-cost, customizable digital wealth management tool, really for that aim of democratizing wealth management that can deliver hyper-personalized portfolios for goal-based investing. We have our Storyteller. This is a worldwide first. It's a new way of telling the story on portfolio performance. And lastly, Portfolio Optimizer, which you'll hear a little bit more about today, is a next-generation quantitative tool that provides cost-effective solution for efficient portfolio management. So without further ado, I'll introduce Emmanuel Wildiers. As I mentioned, he is heading our investment research and development at InvestSuite. He was previously Senior Quantitative Equity Portfolio Manager at Schroders, VP at Northern Trust Asset Management, leading portfolio construction and quantitative equity strategies at KBC Asset Management. He's a CFA and CAIA charter holder. So without further ado, Emmanuel Wildiers, I'll pass it to you.
Great. Thank you very much, Joyce. Just share my screen.
Yep.
Good morning, everyone. So in the next few minutes, I'll explain what we mean exactly when we talk about benchmark-aware portfolio construction. I'll zoom in on the use of tracking error as a metric to measure and optimize benchmark relative risk. I'll also talk about a drawdown-based risk measure, IVAR, which we developed here at InvestSuite and which we believe is a more effective risk measure than tracking error. And finally, I will present Portfolio Optimizer, which is the InvestSuite framework for quantitative portfolio construction. And after I'm done, Martin will take over and demonstrate what all of that means in practice. So when we talk about benchmark-aware portfolio construction, what we mean are portfolios that either aim to follow a benchmark or aim to outperform it with limited benchmark relative risk. So if you look at the bottom of the slide, at the spectrum that ranges from pure index fund management on the left to fully unconstrained long short management on the right, we'll mainly be talking about the left part. So for example, that's direct indexing, where we directly build index tracking portfolios for end customers. Enhanced indexing, where we use some techniques to try and slightly outperform the benchmark. And factor investing, where systematic tilts, for example, to quality, value, momentum, or ESG factors, are incorporated in a portfolio with the aim of either generating outperformance or other positive impact, such as sustainability. So the questions that we'll dig into next will be, first, which risk measure to use for the purpose of benchmark-aware portfolio construction, and we'll also present the InvestSuite tools that can assist with that process. Finally, I just wanted to highlight that, well, in the current day, benchmark-aware portfolio construction is not just the exclusive terrain of fund managers anymore. So we increasingly see asset owners like pension funds and sovereign wealth funds bring this expertise in-house. Also, wealth managers are starting to employ direct indexing solutions for their end customers, which can take into account individual preferences, for example, investment universe, ESG characteristics, and also allows for more efficient, tax-efficient solutions. Especially in the US, direct indexing is one of the fastest growing parts of the investment space. And finally, of course, the rise of robo-advisors has also brought benchmark-aware portfolio construction to smaller retail portfolios. So I'm fairly sure every one of you will at least have heard about the term tracking error to measure relative risk of a portfolio compared to a benchmark. So to calculate tracking error, you would start with the time series of a portfolio in a benchmark. I've shown an example on the bottom left. You calculate the returns of the portfolio, the benchmark, for each period, which you can do on a daily, monthly, or annual frequency. Here, I've used annual. And then for every period, you take the difference between benchmark and portfolio performance, and you take the standard deviation of those differences. And that way you arrive at a single number, which in this case would be 2% being the tracking error of this benchmark in this portfolio. Perhaps it's good to remember where that measure actually comes from and why it's so popular. It's a simple extension of volatility. Volatility is the standard deviation of absolute returns and tracking error of relative returns. And volatility was first proposed as a risk measure in 1906, but really made famous by Harry Markowitz in his portfolio selection thesis, where he introduces the concept of mean variance optimization, which of course takes volatility or variance as the risk measure. So why did Markowitz use volatility tracking error as a risk measure? Actually, not because he thought it was the best risk measure to use, but it had two big advantages for him at the time. First of all, for simple cases, it allows for nice closed form solutions to give you the optimal portfolio. And that's, of course, handy if you want to write a doctoral thesis or win a Nobel Prize. And secondly, for more complex problems, which you can only solve numerically, Markowitz had developed a very efficient critical line algorithm, which allowed him to construct portfolios using 9052 computation technology in a matter of seconds or minutes. But it has a few downsides. First of all, it doesn't match at all with how real investors perceive risk. Nobody lies awake at night worrying about the standard deviation of their returns. Real investors care about drawdowns or relative drawdowns in this case, and recovering from those drawdowns as quickly as possible in case they do occur. A second disadvantage is that it describes the interaction between two assets with one single metric. So it throws away a lot of information, which is of course needed to make it optimize quickly in 9052. But it has some downsides. It causes overfitting and sometimes very unintuitive solutions. So to show an example of the drawdown tracking error, I've shown two portfolios at the bottom. So at the left, you see a portfolio that continuously underperforms the benchmark at a very constant rate. And the portfolio on the right, it underperforms the benchmark from time to time. But when it does, it tends to outperform in the next period. So mathematically, you would say that the two series are co-integrated. But even though the portfolio on the left will have a tracking error of 0, the standard deviation of a constant relative return is 0. The portfolio on the right will have a tracking error of 1% because it kind of ignores that autocorrelation, that co-integration. So from a risk perspective, investors should prefer the portfolio on the left, but of course, in practice, nobody does. It has much bigger cumulative drawdowns. So that's why in InvestSuite we have developed our own measure of risk, which we call IVAR, and it's a drawdown-based risk measure. So what we do to calculate it is we start by drawing a graph of the outperformance of a portfolio versus a benchmark. So that's what you can see as the black line. We then draw the maximum outperformance up to each point in time, which is the top of the pink areas. And then we will calculate the difference between the two. So between the running maximum and the actual outperformance graph, and that's visualized as those pink areas. So you can see that very intuitively, the sum of those pink areas, which is what we call IVAR, is related to three aspects of drawdown. So first, how often is there a drawdown, a relative drawdown? So that's how many of the areas you have. How deep is the drawdown? That's the height of the areas. And how long does it take to recover back to the benchmark, which is the width of the areas. So it's very intuitive in terms of what investors really care about. Finally, I'll say a few words about InvestSuite's portfolio construction solution, which we call Portfolio Optimizer. I'm not going to go into any details at all. I just wanted to emphasize that it's an extremely flexible framework, which can even include custom data from our clients, such as their risk models or their custom factors, their expected returns. It can not only optimize for risk and return, but also take into account tax liability, ESG, factor tilts. It can pretty much use any risk measure that's ever been proposed in academia, so IVAR, volatility tracking error, but even a lot more. And it also supports a very wide range of assets. So our optimizer has even been powering the first ever crypto robo-advisor for more than 3 years now. And it's also very scalable. It's cloud native, serverless, which means that we can run thousands of portfolios in parallel, which of course we need for our robo-advisory solutions. In practice, there are 3 ways in which our clients can use Portfolio Optimizer. So first option is through our in-house robo-advisory solution, which provides a front end to end customers and their advisors. A second solution is through an API, which allows for direct system-to-system integration. We have a very well documented API for that. And thirdly, we have recently developed Model Builder, which is a lightweight front end that can be used directly by portfolio managers to build custom model portfolios that can then be exported to other systems. And Martin will demo that in much more detail. So with that, I'll give the word back to Joyce.
Okay, thank you very much, Manuel, for that overview of tracking error and relative IVAR and showing how IVAR can capture a more human-centric perception of risk by focusing on drawdown. And also thank you for introducing the Portfolio Optimizer. And now to go over the optimizer further, I introduce Martin Wins. He is the product manager for the solution. He comes to InvestSuite from quantitative financial risk management at KBC Asset Management and financial engineering at Math Finance. He holds a PhD and master's in financial mathematics. Without further ado, Martin Wins.
Thank you, Joyce. Thank you for the introduction. Indeed, as said, we will first give a practical example of the difference between tracking error and relative IVAR. So what I will present is 2 backtests that we performed, one on the stock 600 and one on the S&P 500. So for both indices, we construct the backtest first with relative IVAR. So we try to minimize relative IVAR with a maximum of 100 instruments. And the second backtest, each time we try to minimize the tracking error with also a maximum of 100 instruments. So we did it for both the indices. Best to say maybe that stock 600, it's very much similar with MSCI Europe, so that all of you can have a notice of what it holds. So here on this graph now you see the total return series over the past 12 years of the stock 600 Europe, and now drawing in dark blue the total return series of the minimized tracking error backtest with a maximum of 100 instruments. So you see that over the past 12 years, indeed, the performance was very similar. So you could say, okay, it does a very good job at tracking the index. Now let's draw the line that we have if we do the same backtest, but then minimizing relative IVAR. So at first sight, you would say that it's less good at tracking the benchmark because over longer term, there's a larger difference in performance. But as Emmanuel explained, people don't care about a better performance than the benchmark. They only consider risk as performing worse than the benchmark. And therefore we dive a bit deeper. So we show the outperformance of both backtests versus the benchmark. Now, first, if you look again at the dark blue line at the minimizing ex-ante tracking error, then indeed you see the effect from both putting a penalty on positive deviations from the benchmark and negative deviations of the benchmark. So indeed, in some periods, your performance is a bit better. In some periods, your performance is a bit worse than the benchmark. But if you look at our approach, then typically what you try to do is you try to limit the periods on which you have negative performance versus the benchmark. So actually what we try to do is to create that this outperformance graph is monotonically increasing. And of course, that's not possible to make that, but you can at least optimize for it. And also, if we can summarize the backtests in a couple of numbers, then we see if we look at the ex-post tracking error, so calculating the tracking error after we have performed the backtest, that actually the ex-post tracking error for both backtests is very much similar. But as explained, in our case with InvestSuite relative IVR, by mainly deviating on the positive side. And that's also summarized in the second number. So it's the maximum relative drawdown that you see during the whole backtest. So it's the top to bottom, the maximum top to bottom that you see in the graphs below. And then clearly you see that if we use relative IVR, then the maximum relative drawdown is much smaller than if we use minimized tracking approach. And actually the same we see for a backtest for S&P 500. So again, the total return series of the index. Minimized tracking error seems to do a quite good job. Also, you see a slight underperformance over the longer term. But again, if you consider our InvestSuite relative IVR approach, then you see indeed that on the longer term, we tend to outperform, not because the algorithm is not tracking well, but only because we put a limit on the drawdowns versus the benchmark. So again, showing the outperformance graph, you see indeed that in this case, it's a bit more difficult to do a good tracking of the index because there are some specific stocks that have a major influence on the total return of the index. But still you see that indeed our methodology tries to monotonically increase versus the benchmark. So if you have to deviate, you try to do it on the positive side. And again, we have our numbers that summarize the backtest. So in this case, even our methodology has a lower ex-post tracking error than if you would minimize for ex-ante tracking error. So even if that would be still your measure of risk, you see that it's still, it's also performing a very good job, but by limiting the negative performances versus the benchmark. And that's perfectly summarized in the last number again, the maximum relative drawdown, the top to bottom. You see indeed that the maximum top to bottom in our backtest is much lower than in the one if you would use minimized tracking error as your approach to track the index. Now let's go over to a live demo of our model portfolio builder. So there I will demo in a live way how you could do this yourself via our model portfolio builder tool. So I will start with just the example that we had here. So try to track the stock 600 as good as possible with a maximum of 100 instruments. But then I'll show all of our hyper-personalization approaches. So as Emmanuel explained, it's hyper scalable because we are running our optimizations in the cloud. And as such, we can really support hyper personalization for each and every end client. So I'll show that, I'll demo that for ESG scores, gender aspects in your portfolio, but also for fundamental factor tilts. So let's now go to the demo. So what I've done here is I logged into our model portfolio builder. I selected euro as the base currency because if you use the stock 600 as an example, you'd like, of course, to express yourself in euro. We took all constituents of the stock 600 for the optimization. Of course, as a benchmark, we also considered the stock 600. And let's now do the example that we did before, but then in a live demo where we now construct a portfolio. So we try to track the index as close as possible, but then with a maximum of 100 instruments. So let's build the model portfolio. So now our optimizer is running live to create the portfolio. And here on top, you see the past performance of both portfolios. So it's not a backtest here, but it's the past portfolio of both portfolios that we simulated. So as you can see, we have a portfolio with at most 100 instruments, and it tries to track the stock 600 as good as possible. And if it has to deviate, you try to do it on the positive side. Now let's go a bit deeper indeed to the high personalization. So for example, if you look at the ESG scores, then of course, both for the portfolio that we constructed and the one of the benchmark, the ESG scores are very similar. Now let's suppose that ESG is very important for you or for your client, then you can tilt your portfolio. So let's tilt your portfolio now against an ESG combined score. So on an overall level, you want to increase the ESG performance of your portfolio. Then you just give a tilt to the ESG combined score. And again, on the fly, you can build the model portfolio again. So you see again, in terms of tracking, it performs very good. You again have at most 100 instruments in the construct portfolio. You of course see some different names because we now focused on those ESG aspects. And now indeed, if you consider the ESG aspects in your portfolio, you see indeed that we tilted towards ESG combined score. So we made sure that the portfolio that we constructed for you has a much better ESG score than the benchmark. But of course, for a lot of people, ESG scores, it's not really tangible. They don't know what it is. So what we can also do is really dig deep. Let's say we can take some concrete measures like CO2 to revenue, or like women percentage managers, gender pay gap, whatever that you like to boost in your portfolio, where you want to put emphasis on, that we can include as well in the portfolio. So let's, for example, take the percentage of female employees. Both in our portfolio and the benchmark, we have around 40% of female employees. Let's say now that you or one of your investors thinks that this is very important, that you have, let's say, an equal amount of women in those companies. Then you just put a tilt on that specific factor, and we will make sure that you can build a portfolio that still tries to follow the index as good as possible, but on top of the ESG combined tilt, also put a tilt on the percentage of female employees. So indeed, you still see that the ESG score in your portfolio is much better than the one of the benchmark. But now if we scroll down, then we see that the percentage of women employees indeed increased from around 40% to 51%. So you can really put a focus in your portfolio on the aspects that you think are important for you or for your investors. And of course, it's not only about ESG, as Emmanuel talked about fundamental factors. Indeed, at InvestSuite, we also have our own fundamental factors that we compute. We call it X-ray factors. So we have a couple of fundamental factors that we can compute for all of the stocks in your universe. And so in this case, you see an overview here. And also here, you notice the same thing. So of course, if you don't put any tilts, the fundamental factors in your constructed portfolio are very much like the benchmark. But suppose now you really believe in value stocks, then you just put a tilt toward value stocks again, and you can construct a portfolio that not only has at most 100 instruments, that not only has a boost towards ESG combined score, that not only has an equal amount of women in the portfolio as employees, but also a boost towards value. So again, you see very good at tracking the index. Some other names popped up again in the top, let's say, positions of your portfolio. Still, the ESG is boosted. If we look at the women percentage employees, we see that still you have around 50% of women in your portfolio. But now if we look at the fundamental X-ray factors, indeed, we tilted towards value in your portfolio. So really a very powerful tool that can create hyper-personalized portfolios and still do a very good job at index tracking. So it's very much suited for direct indexing solutions as well, as you can see. So let me now show that this is not, let's say, some magic, that we also have backtest for it, that we also have let's say, some scientific evidence that this works. So we actually performed a backtest for each of the examples that I showed, except for the one with X factors, because for X factors, we don't have any historical data point in time at this point. But for all the examples that I showed with ESG components, for those we have historical ESG data as well, so we can conduct, let's say, trustworthy backtests with those. So let's go over the backtest now. Same as before, stock 600, but then also with our ESG factors. So here you again see the total return, the stock 600. How we could track the stock 600 without any limitations. Then how we could track the stock 600 with a maximum of 100 instruments. So this is exactly the graph that you have seen before. Now, what would have it been done if we would have tilted at any point in time towards ESG? Well, that's the graph that you now see in green. So in some periods, it's a bit better in tracking the index. In some periods, it's a bit worse. And that's actually the same that we see if you look at the backtest, where we both included ESG and the tilt towards the percentage of female employees. So of course, the more restrictions you give to the portfolio, the harder it gets to track. But there, the bottom line is, again, if you use a relative IVOR, then if you have to deviate from the benchmark, you try to do it on the positive side. And that's also summarized a bit in this graph, where you have, again, an overview of all backtests, and also in this outperformance graph. So this graph shows, again, like before, the outperformance of the backtest versus the benchmark. So what you see is the more restrictions you give to the portfolio, the harder it is to get a monotonic outperformance graph. So the more drops you have in the outperformance, the more periods you have where there is an underperformance versus the benchmark. But still, over a longer term, you try to deviate on the positive side. So that's also what we see in the summarizing numbers. So if you look, for example, at the ex-post tracking error, the more restrictions you give to the portfolio, the larger the ex-post tracking error becomes. And the more restrictions you give to the portfolio, the larger the top to bottom, the maximum relative drawdown number gets. But still, as said, over time, you try to deviate from at the positive side. So to see now what influence this had on the point in time ESG scores from the portfolio, we only do that for the last backtest. So where we both put the tilt towards ESG and towards the percentage of female employees. There you see indeed that we gave a nice boost during the entire history of those backtests to ESG. So a nice tilt toward the ESG combined score. And the same we have actually for the percentage of female employees. So if you look at our backtest, our portfolios, then during the whole backtest, they had around 50% of female employees in the portfolio. Whilst if you look at the benchmark itself, at the stock 600 itself, there you clearly see an underweight of the percentage of female employees in the portfolio. So really showing that we have created a powerful tool to track indices, to put your personal beliefs in the portfolios, and given those personal beliefs, if you have to deviate from the index, that you can do it, let's say, in an improved way, where you only put a penalty on negative performances versus your benchmark.
All right, many thanks, Martin. So to wrap up in the last minute, today we went over benchmark-aware portfolio construction, tracking error, and a next-generation alternative relative IVAR, how this and Portfolio Optimizer can be used in practice, incorporating not only constraints to the benchmark, but also other factors such as fundamental factors, ESG, and even the most specific ESG impact focus criteria. We then showed very impressive backtest results over the different scenarios. For any attendees that would like to learn more about Optimizer or get a more detailed demo, please reach out to us. We did have a lot of questions in the chat box as well as Q&A, so we will be reaching out to those people directly. Also coming up on March 9th, we are hosting the second webinar of our 30-minute series on demand portfolio performance reporting. What we see is that firms take a lot of effort to compile regular performance reports, which are not always easy to understand or engaging, and it takes even more effort to provide something that's meaningful in a personalized way. So we'll speak on how we're leveraging technology to automatically generate narrative-based insights on both client portfolio and fund performance. So again, a big thank you to our speakers and of course to all of our attendees. We will connect with those individuals who dropped questions, and for anyone else who's interested, please follow us on LinkedIn or visit our website. And for any additional information, please feel free to email me directly at joyce.chu@investsuite.com. Thank you again, and we hope to see you at our next webinar on the 9th of March. Thank you, everyone.